Fed up. Gold breaks $2,500 an ounce on August 16th, 2024. With the U.S. economy showing signs of continued weakness, jobs falling, inflation falling, and unemployment rising, this is a perfect setup for the Fed to cut rates at their September meeting. The question is, will Chairman Powell telegraph that at the conclusion of their Jackson Hole meeting in Wyoming, August 22nd and 23rd, just a few days from now? Meanwhile, gold has broken $2,500 an ounce for the first time in the spot market, and more gains are likely. In this gold market commentary, we'll drill down on what's happened over the last several weeks with both employment, inflation, and show you what's happening with yields, Treasury yields, and the dollar, which are both easing, helping to propel gold. So let's get into our update. I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. We are a national physical precious metals and vintage U.S. gold and European coin mail order dealer operating out of Austin, Texas. Here's our web information and our contact information. If we can help you, we'd love to have the opportunity. Here is our update. Fed up. Gold breaks $2,500. Jobs and inflation weaken. Unemployment rises. The U.S. dollar and yields tumble lower. Gold is already starting to front run the expected September rate cut. And we remain in the exact same setup as we were in May of 2019 before gold gained 15%. And we're in a similar setup to 2007 when gold gained 50%. Meanwhile, silver is lagging. It's been under $29, but it just caught back up to $29 today. Let's go through the charts and see what's been happening to drive all this. Well, first of all, we got the jobs report in early August for July, and the new jobs were anemic at 114,000. You can see over the last year and a half, the break-even speed for the unemployment rate, according to one of the Fed governors, is about 230,000 jobs a month. And for the last 4 months, we've been below that threshold level. In April, we had a weak jobs print of about 108,000. We had a really good May and a decent June print. And now we've got the weaker July print at 114,000. So the economy, as far as jobs are concerned and hiring, is slowing down. And we are below break-even speed for the unemployment rate, as that's clearly seen rising from 3.7% in January to as high as 4.3% now. So job creation is slowing down and the unemployment rate is rising. So that's part of the Fed's mandate. It's full employment. Their other mandate is for stable prices. And we got the inflation print in the last couple of weeks as well. And for the first time since March of 2021, headline CPI has fallen below 3%. Meanwhile, the core CPI is continuing to ease lower as well. And another sign that the U.S. economy is slowing a bit. We're seeing companies starting to lose pricing power in this economy, which bodes well for further lower inflation. We'll see. So what's been happening? Well, the dollar has taken a real tumble in August in reaction to these weaker economic numbers. It's been holding range bound, primarily in the bigger range on this chart, from 102.70 to 105.50, with a midterm support and resistance level at 104.25. And we've been over that for most of the spring going into July. We broke it a little bit in July, and now we've taken a big tumble, not only into the lower half of that bigger trading range, but we've broken major support at 102.70, with the dollar index trading today at the close at 102.30. So this is a substantially weaker dollar over just the last couple of weeks. And remember, gold tends to trade inversely to the dollar. If the dollar is stronger, gold tends to be weaker in price. And if the dollar is weaker, gold tends to be stronger in price. We're seeing a similar situation with Treasury yields. Treasury yields have been leading a little bit. They've started coming off in July, but they've really broken down now in early August. They've rebounded a little bit, but this is the same setup we've been in twice in 2007 and 2019, where yields were falling before the Fed cut rates. And as you can see, the yields have tumbled, but the federal funds rate remains at the top of that chart on the right at 5.25% today. Which begs the question, will Chairman Powell telegraph an anticipated September quarter point rate cut at their Jackson Hole meeting next week? And this is an article from Barron's. I think that they're going to do it. Time will tell. Now let's take a look at what happened the two previous times we went into a Fed rate cut cycle. This is a 4-year chart going back to 2007. You can see at that point in time, the Fed funds rate and the Treasury yields were about the same at about 5.25% at the top. Both started to come down at the same time. Then the Treasury yields found stability and then they tumbled again. Well, that's actually when the great financial crisis started, but the Fed led the way lower. At that point in time, gold went from 660 to 990 for a 50% gain. And here's the gold chart from that period of time. Now, under normal circumstances, the Fed, this is a pretty big Fed rate cut from 5.25% to 2.25%, but still gold gained 50%. And a little bit of that last leg up was when Bear Stearns started to have rumored problems in early 2008. So that takes us into the beginning of the great financial crisis. But still, the Fed had not slashed rates all the way down to zero. That big V-shaped area that you see to the right of the highlighted area on the chart here into 2000, end of 2008 and early 2009 is the liquidity event that the great financial crisis caused. And then following that, the Fed did slash rates to zero, and gold went from under $1,000 an ounce to $1,900. This is a much more similar setup to where we are today. And this is the Fed funds rate and the 10-year Treasury yield in 2017, 18, and 19. Now, that red circled area is the area where yields are falling before the Fed cuts rates. Now, the point to make here is in a normal economic environment, the Treasury yield should be above what the federal funds rate is in a healthy, normal functioning economic environment. So at that point in time, yields began to tumble, but the Fed hadn't cut rates yet. We saw that happening, yields falling before the Fed cuts. We got an alert out to our clients when gold was still $1,330 before the Fed cut rates. When they actually cut rates, gold gained 15% to $1,520, ultimately going to $1,560. And then things stabilized a bit. And then COVID came, the Fed slashed rates, and we went all the way to 2070 gold. Gold gained 55% from start to finish in that run. And here we can see it on the gold chart from the same period of time. This is the point I would like to make here. The first Fed cuts that we had in 2019 from 2.5% to 2%, which gave gold a 15% gain, were in a fairly normal run-of-the-mill economic slowdown leading into a mild recession. The second set of cuts from 1.5% to zero, when gold went from 1675 to 2070, that's when COVID hit and we had real economic distress. So that begs the question, where are we today? I think what the economic environment that we're in now is more like we were during the first part of this rate cut cycle back in 2019. Unless the economy really slows down materially or comes to a halt, I do not think that we'll see the Fed slash rates dramatically, nor go into QE. But if we do get into that environment, gold could make another big gain from here. So I've been telling you about this since in our July 13th video, setting the table for where we are now. And here's a 1-year gold chart, and gold is already starting to react to the anticipated Fed rate cuts. You can see that it's been climbing a steady series of higher highs and higher lows, and it's just in the last 2 weeks, week and a half, that gold has broken sharply higher after holding a much higher bottom at 24.30. Now, the previous short-term low is 23.53, and that's about where gold was when we sent out our video setting up this, hey, we're in the window of opportunity where rates are falling before the Fed cuts rates. And now as we break 2,500, we're actually entering into the real shoot of the meat of the action, where a Fed rate cut could push gold into the 2,600 to 2,750 range, which is what I anticipated in our July 13th video. This is a story from Barron's today this is a story via MarketWatch today, rather. Gold prices keep breaking records as central banks are driving the rally. Thank you to all of you who watched our last video, which explained in detail how central banks are buying record amounts of gold since we weaponized the dollar following the invasion of the Ukraine, and they're helping to drive the rally. Well, I've been preaching this since June, all summer long, and it seems like the mainstream press is starting to get the memo. Here is a candlestick chart going back 6 months of the daily gold price action. It pretty much mirrors directly the 1-year gold chart I just showed you, so I won't belabor the point. As you can see, though, we have had a series of higher highs and higher lows. What's worth noting here is when the markets hit a lot of turbulence on August 3rd, following the weak jobs print, gold didn't sell off that much. It did come down to about 24.20 from 24.85, but it rebounded quickly thereafter. When there's a market liquidity event, gold gets sold down briefly. I call it throwing the baby out with the bathwater, but quickly you realize, hey, there's the baby. We got to get the baby back. And gold is rebounded, and now we have another new high today at 25.48 on the candlestick in the futures market. Here's a 1-year silver chart. Silver has been disappointing. In late July, it broke major support at $29, and now it's tumbled all the way down to $26.94. And it's been trading primarily between about 27.25 and 28.50. And just today, on the back of gold punching higher, silver made a big gain and is back to 29. To me, it looks completely undervalued. We'll get to the gold to silver ratio chart in just a second. Here is the candlestick chart. Again, it mirrors the 1-year chart, but that sell-off in silver, when silver was breaking support at 29 to start with, when the stock market took a big tumble and all markets took a big tumble on August 3rd, on that Friday when the jobs report came out weak, silver got hit very hard that day, more than gold, because it's more of a commodity metal than a monetary metal. And if we're going into a slowdown, silver's commodity value will be hampered a bit, but it's trying to rebound now, and it's regained back up to resistance, where resistance will be at 29. We'll see if it can get back over into the $30 range as time passes. I think that will happen. With regard to the gold to silver ratio chart, we're back up to over 85-1 at 87.5 today, with gold at 25.46 and silver at 29.08. We did get down to about as low as 73-1 when silver was playing catch up and got to 32.5. But in the meantime, gold has taken the lead again, and silver has lagged, making silver a better value in my opinion, but gold is going to continue to lead. I think silver, I continue to believe that silver should be closer to $40 an ounce than $30 an ounce, and under $30 an ounce. The way things are going, to me, looks like a real bargain, especially when the gold to silver ratio is close to 90 at 87.5. And speaking of silver, we have a special on 2023 mint sealed boxes of silver Britannias. These are left over from last year's production. We've got them as low as $2.79 over spot in quantity. And that is a great deal on a sovereign minted 1-ounce silver coin. So once again, we are American Gold Exchange out of Austin, Texas. I can't thank you enough for your patronage. We never forget that without our clients, we don't have a business. So thank you so much for your support, your trust, and your loyalty. If you like what we're doing, please subscribe to our YouTube channel and like this video. This is how we're keeping you apprised of what's happening in the markets going forward. And it'll be very exciting to see whether Chairman Powell does indeed telegraph a rate cut during the Jackson Hole meeting and how the markets respond to that. And then, of course, will the rubber really meet the road in September when the Fed meets? We do believe we will get a 1/4 point rate cut at that point in time. So that's our update. Thank you so much. Have a great day.